This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
So this is our last what we call our Us episode of 2020. We're back next week with our year in review episode, and then we're skipping the New Year's Eve week, so you get 2 weeks to listen to the best of 2020 show, which I think would turn out to be a great episode. So hopefully you'll enjoy it. And then we're back on January 7th with a phenomenal special guest. And we got guests lined up right through, I think through April now. We have an amazing lineup coming up. One thing I wanted to highlight for everyone who happens to be a Peloton rider, I set up a hashtag last week, hashtag Rational Reminder on Peloton, which is actually really cool. I didn't know how well these hashtags work, but when you go on a ride that other Rational Reminder people have been on before, it shows up in the race standings, and it's all live standings where they were at the point that you're at in that current ride. So actually, our mutual friend Mike in London, he was on there as a Rational Reminder on a ride I did on the weekend, and I had to ride pretty hard to make sure I beat him, even though he did the ride a few days earlier. So it's really cool. So love to see more of our listeners on the Peloton hashtag at Rational Reminder. Also want to give a shout out for some reviews, some really nice reviews that people left online. Jason Meyerson, who was really stoked to find out they were Ottawa based. He lives here in town. JG98765, and also Struthion Day. I know you always laugh at these, so I presume these people know who they are. I just want to give a shout out and say we appreciate them. Community board updates you wanted to share?
Yeah, we're closing in on 1,000 users in the community, which is pretty neat. And as I've mentioned before, the discussion that's going on in there is great. It's a lot of really intelligent discussion. I've been continually impressed with how that community is developing. So I think it's a really good resource and a really good place for people to share ideas and ask questions about podcast episodes, but also otherwise. I mean, I would say most of the discussion is not surrounding podcast episodes. It's also where we would prefer people to discuss the podcast episodes, just to keep it all in one place to make it easier for us to answer and participate. But most of the discussion over there is related to the podcast content, but not necessarily about, like, it's not in the threads that we post for the podcast episodes. So lots of people are asking great questions and lots of people are providing great answers and nuanced discussion points.
And for those who are watching this on YouTube, you'll notice Ben has his new Common Sense Investing CSI hoodie on, which I think we're going to offer for sale in the merch shop.
I don't know.
If there's enough demand, if anyone's interested, drop us a note. If there's enough demand, we'll go and get some stock in the new CSI hoodie. And we still have free socks from that listener who was very kind to give us a deal on some custom Rational Reminder socks. Quickly, I want to give you, because I sometimes think you enjoy getting some tips for Netflix. Have you seen this show, We Are the Champions?
As usual, I've seen it. I haven't watched it. I've seen that it exists. Haven't watched it.
We started watching it on the weekend. It's hilarious. It's like eight or nine, maybe 30-minute episodes. And it's all these crazy competitions that go on around the world. Like this cheese rolling race in the farmlands of England. There's this hot pepper eating contest in the southern U.S. This weekend, we watched one on frog jumping. Like, there's families that have been frog jumping for like 6 decades, 3 generations. Another one we watched was dog dancing. They're unbelievably passionate people into these completely wacky competitions, and they document a bunch of people competing. Another one was yo-yo. There's this massive yo-yo competition that goes on every year, and it's very well done. It's short, it's funny. Highly recommend it. We Are the Champions on Netflix.
Cool. Should we go to the episode? People will know from the title because I'm sure I'll put it in there. But in this episode, we introduce finally the new model ETF portfolios. So hopefully they meet everyone's presumably high expectations.
The anticipation is palpable. So with that, let's go at episode 129.
Welcome to episode 129 of the Rational Reminder Podcast.
It sure is. So this week we'll kick it off with a book that I just finished. And it's a book that's been popping up everywhere in my Twitter feed. So I figured, well, maybe it's some sort of message to me that I should be reading it. So it's called Almanac of Naval Ravikant. So Naval is an Indian-American entrepreneur and investor, and he's actually the co-founder of Angel List. And he's invested in, I think, over 200 early-stage companies such as Uber, Foursquare, and Twitter. I did not know a lot about Naval beforehand. But this book is not a book about him. And this is what's pretty cool. It's actually a collection of his thoughts and philosophies that he's put out on Twitter over the past decade and in podcast interviews. But what is really cool to me is that it was actually assembled by a guy named Eric Jorgensen, who's a product strategist at Zarly. Anyways, Eric was so taken by all these things that Naval has put out there that he decided to assemble it into something, as he described, something more permanent, because he felt that the thinking of Naval was so good they deserved to be put into a durable long-term format or a book. And on top of that, Eric went and put this out for free. So you can actually download the PDF, and it's all kinds of different formats. I actually bought it on my Kindle, but you can download it for free at navalmanac.com. So that's NAVALMANACK.com. And it's all there for free. And I really, really enjoyed it. It's an assembly. So you can see Eric posts all kinds of different tweets that he's given, that he links in quotes from different podcasts. So it answers all kinds of questions that were posted of all, like, how important is luck? Is there value in networking? What is your definition of retirement? What is happiness? And a lot of it is around happiness and wealth. It's also full of what I thought were interesting quotes and thoughts. And here's some examples for you. So in any situation in life, you always have three options. You can change it, you can accept it, or you can leave it. Here's another one. To make an original contribution, you have to be irrationally obsessed with something. Here's a good one for us. Science is the study of the truth. It actually changes the world. He defines the modern struggle as lone individuals summoning inhuman willpower, fasting, meditation, and exercising up against armies of scientists and statisticians weaponizing abundant food, screens, and medicine into junk food, clickbait news, endless games, and addictive drugs. I can't say enough about it. I actually got it for my kids for Christmas, so we'll see if James listens to this before it actually gets posted before Christmas. But I really enjoy it. I liked how it was laid out. It's a very fast read. It's an interesting read, and you can kind of just pick it up at any point and just dive in. So there's your book recommendation for the week.
Cool.
In other news, there was a tweet last week from Nate Gerasi. So this is more a question to you, just based on some of the feedback we've been getting on the community board. So Nate Gerasi posted last week that table stakes for major brokerage firms within the next few years will be fractional share ownership, direct indexing, cryptocurrency.
Custody of cryptocurrency.
Custody of cryptocurrency. Easy custody of cryptocurrency, exactly. So I just thought it's a neat link going back to our interview with Josh and Brian, I think 3 weeks ago or so, just about the drive towards kind of personal biases and personal desires in a portfolio versus the evidence, or as Josh called it, the orthodoxy. Thought it was neat how Nate Gerasi is now saying that exactly what they were arguing, that the ability to do kind of what feels right for you is going to be easier in the brokerage world.
I think if we define table stakes as what you need to be able to sell more stuff and increase margins, then for sure. Fractional shares, I think, are important regardless. Direct indexing, though, from a practical perspective, from the end investor's perspective, I don't think it's particularly useful, especially after costs, because we know it's going to cost a lot more to have a direct index portfolio than it is to have a cap-weighted ETF portfolio. And that's before you start factoring in, factor tilts into your direct index portfolio.
Right.
But if you want to make money as a brokerage, then yeah, of course you need to have that.
Yeah.
Crypto custody, same kind of thing. Like that stuff's not going away.
No. Another data point I wouldn't mind your feedback on was the percentage of S&P 500 stocks with a dividend yield greater than the 10-year U.S. Treasury yield. Currently, it's 63%, which is the highest by far in this table. It goes back to 1990. The average ratio is just under 20%. Any thoughts on that?
Thoughts from what perspective?
What do you think is driving? Do you think it's the low level of the 10-year Treasury? Do you think it's, I guess we don't know what's really going on behind the scenes. Is it the fact that a lot of dividend-paying companies might be in the smaller mid-cap range, which have not had the kind of rally?
I don't know. I mean, prices are, this is yield, right? Yeah. So prices are high. Stock prices are high. Yields are low. U.S. companies are paying, and what they're comparing this to 1990. U.S. companies have been paying less and less in dividends. So, I mean, all those things working together. Yep.
And the last story for you, article on Bloomberg.com called "Crashing a $5.2 trillion party." Debut ETF issuers hit a record. So there's been 14 new issuers of ETFs this year. This is not ETFs. This is companies issuing ETFs. There was 10 last year in 2019, so we have 14 so far this year. And make the argument in the article that it's based on new rules for active funds that made the launches easier is one of the reasons behind this. So it also referenced the most dramatic new entrant being Dimensional Fund Advisors, which recently converted 6 of its tax-managed mutual funds into ETFs. And just by doing that, it launched them into 11th place overall in the ETF landscape with something in the low $20 billion range of ETF assets. Now, by comparison, the largest participant or the largest company in the ETF market space is BlackRock at $1.8 trillion, Vanguard at $1.1 trillion, and State Street comes in at number 3 at $700 billion. ETFs have taken in a record $90 billion in November, which they say is an unheard of $5 billion a day pace. And year-to-date flows are now up to $427 billion, which is about $35 billion away from an annual record. So it's just been huge in the ETF market space.
Unreal.
Now, you wanted to talk about Tony Hsieh, the Zappos founder, who passed away November 27th of complications from smoke inhalation from a home fire a week before that.
The only thing that jumped out to me as interesting in that story was the fact that he died intestate. He died without a will. And I just kind of heard this in passing. I think they, one of the podcasts I listened to, I can't remember which one, they aired a old episode where they'd had him on, might have been Freakonomics or Planet Money or something. So I just took a quick read of the story and that jumped out at me as pretty interesting. I mean, this ultra wealthy guy who's been very successful in business, and he passes away unexpectedly without a will. I mean,
exactly.
In most cases, or I don't know if that's true. In a lot of cases, people die without expecting to die. They don't have time to get everything in order. So it just speaks to the importance of getting all that stuff taken care of.
Yeah, he had a net worth over $840 million US dollars.
It's amazing to think about that with that level of wealth, you could still not have all the proper planning in place.
Yeah, and being in business, you think of all the lawyers that would have been around his situation for years, and it was never done.
Maybe he didn't want to do it. Like, who knows what the actual full backstory is? But I found it very interesting that's how it happened for him.
So the family has asked the judge to name his father and brother as special administrators of the estate. But the bottom line is that stuff happens, and you should always have a will in place. So shall we jump into the feature topic this week?
Yeah, let's do it. So this week we're going to combine, not because the content spans both planning and portfolio management, just because we have a bigger topic for the portfolio management piece. So we're going to skip. I guess that's a better way to say it. We're not going to combine them. We're just going to skip the financial planning topic. But I think people will appreciate the portfolio topic that we have lined up. So it's really it's about the new model portfolios, which people will be excited to hear. But I also thought it would be good to run through the main talking points associated with the paper that we're going to put out at the same time as the model portfolio. So kind of just the thinking behind all of it, which also ends up serving as a pretty good refresher of all of the main concepts behind index investing and stuff like that.
Well, that's the best part about it to me, is that it's all in one spot, all the rationale, the papers, the story behind the reasons for this portfolio construction.
Yeah. So index investing, which is kind of table stakes when you enter this world of evidence-based investing, index funds are, I think, pretty well understood, and they're sensible as investments if markets are efficient. So I think people hear that term. I don't know if everybody knows exactly what it means as Eugene Fama stated it. So I'm going to read a quote from the paper where he introduced the concept of market efficiency. So Fama said, this is in 1970. In general terms, the ideal is, and keep in mind, he said this is the ideal. He's not saying markets are efficient, which Fama's never actually argued. So back to the quote. In general terms, the ideal is a market in which prices provide accurate signals for resource allocation. That is, a market in which firms can make production investment decisions and investors can choose among securities that represent ownership of firms' activities under the assumption that security prices at any time fully reflect all available information. A market in which prices always fully reflect available information is called efficient. Now, Fama also says that real markets can't be perfectly efficient in the theoretical sense. They can only approach perfect efficiency, but this hypothesis and this model became, as many people know, the framework for much of the empirical research that's been done in finance since then. Now, from the investor's perspective, and Fama said this explicitly in the quote that we just read, if the market is efficient, then prices, stock prices, bond prices, whatever you want, security prices, they contain information about the expected returns of a security at a point in time. And then the other thing that follows from that is that prices will change based on new information, which cannot be predicted, obviously, just by nature of being new information. So given those criteria or constraints, whatever you want to call them, in an efficient market, the only way to earn extra returns is by taking more risk. Because security prices move randomly, you can't outsmart the market, all the kind of main talking points that people might be familiar with. Now, if you can get excess returns without taking on extra risk, that's known, and we'll talk more about this soon, but that's known as alpha. So a traditional active manager, their goal is to combine picking the right stocks at the right time and timing the market as a whole in an effort to generate excess risk-adjusted returns, known as alpha. Now, we also know that empirically, active management is not done so well. The Spiva reports are often cited as evidence of that. They're not my favorite source just because of the way that they construct the data. Did you know they use Series A funds, at least for the Canadian report?
Yeah, we talked about that, didn't we?
Yeah, I think so. So you've got an extra 1% commission built into the fund returns, and you're comparing it to an index with no fees. So it's not really a fair comparison.
Well, did you not reach out to them to mention that?
I did, and they said that they would think about addressing it in a future report. I never followed up, so I don't know if they did anything with that. But I don't think it would change the distribution too much. Like you'd still have most active funds underperforming. But anyway, fortunately, there are a couple of papers that were in the Journal of Finance that address the same topic, like the failure of active fund management. So there's Carhart in 1997, Fama-French 2010, documented the failure of active fund managers to consistently beat the market, which supports the idea that markets are efficient, because if security prices move randomly, no manager should be able to consistently beat the market. Now, there are some managers like Jim Simons, who we've talked about, and Buffett for a period of time, although he's trailed the market for about 20 years now.
Yep.
But there are investors who are outliers, and you can argue that's evidence of market inefficiency.
But it's still the same question. How do you identify them ahead of their outperformance?
Correct.
Like, what signals would you have used, and can they maintain it? And as we've said with Jim Simons, for example, they've capped that fund forever at $10 billion of assets, and every year they flush out all the gains to keep it at $10 billion. and you can't buy into it. So
yeah, you can't buy into it anyway. There's no point talking about
it. That's Cliff Aston said last year.
Yeah, right. AQR will take your money, but Jim Simons won't. So at this point, where we've talked through so far, markets are efficient theoretically, and the empirical failure of active management is evidence supporting that. Therefore, index funds make sense. Nice and easy. We could stop here, and many people do, which is perfectly fine. And there's been a lot of really interesting discussion in the Rational Reminder community discussion page about that exact question. Like, should you actually factor tilt your portfolio? Should you try and get exposure to the other risks in the market? Now I'm getting ahead of myself. So since the introduction of the efficient market hypothesis, the field, the study of asset pricing, has become this massive field of study, and there have been many systematic risks identified that seem to affect the way the market prices assets. So we said earlier that the market should reflect the riskiness of an asset. The market price should reflect the riskiness of an asset, but we didn't specify what risk specifically it's reflecting. Now, that exact question has not necessarily been answered definitively, but there are some pretty strong theories and models showing which types of risk the market does include in prices. Now, why is this relevant to an investor? It's relevant because the market risk factor, which is what you get by owning a market capitalization weighted index fund, that's only one of multiple risks that currently there are really strong theories and really strong supporting evidence suggesting that there are multiple sources of expected returns. Now, expected returns is another loaded word, which we're going to talk more about in a second. But to keep with where we've gotten so far, there are other types of risk that the market systematically includes in stock prices. Now, having exposure to just one of those, so if you just have exposure to the market risk, that's delivering one source of expected returns. It's giving you one risk. Keeping in mind, in this context, taking these risks, these systematic risks, is actually a good thing. It's not a scary risk. It's a risk that you're taking
exactly
with the expectation of a positive long-term return. But you can access more than just one risk. And this becomes quite interesting from the perspective of portfolio management for a lot of different reasons, which we're going to talk about a lot of them. There was a paper in the Journal of Portfolio Management a while ago, and I don't remember I think it's called "The Death of Diversification Has Been Greatly Exaggerated." And they argued in that paper that while correlations across geographic regions in the stock market have increased over time as the world's become more globalized and all that kind of stuff, the independent risks, the independent systematic risks that we're going to talk more about, they have not increased in correlation. So that papers that I'm talking about, they actually argue that factor diversification, so getting exposure to more than just one risk, is more important at this point than geographic diversification, which is a pretty interesting argument. So what we're going to talk about and what we included in the model portfolios that we're addressing here are 5 systematic risk factors that are included in the Fama-French Five-Factor Model. So this is Eugene Fama and Ken French, pretty big deals in the empirical and theoretical finance space. And they have an asset pricing model that includes 5 risk factors, the market being one of them, but also four others. So we're going to talk through what those are. Now, I mentioned expected returns being a loaded word, but it's an important concept. So when you buy a stock, this is theory. When you buy a stock, theoretically, what you're buying is a right to a company's future profits. Now, this part can get confusing for a lot of people because where do the returns come from? Expected returns, the returns that you expect to receive, come from how much of a discount you apply to those expected future profits. For a riskier asset, you'd apply a bigger discount. You're paying less for the same amount of future profits if those future profits are riskier. Now that discount, discount rate,
the price you're paying,
is your expected return. Right. So a firm can be really profitable.
That's the key.
And not produce very good returns if you pay a lot for those profits. And we see that with growth stocks. And we've talked about that quite extensively in past podcast episodes and on the Common Sense Investing YouTube channel. So it's really what you pay for the asset that dictates your expected return. And that concept, that discount rate concept, is what ties asset prices to expected returns. Now, I mentioned asset pricing models. I kind of just made a reference to the fact that we're talking about one of them that Fama-French have come up with. And all asset pricing models are doing is trying to figure out which risks are relevant to the pricing of stocks. So in this case, we're using one, and there's no single correct model. I think it starts with deciding what framework you want to use to think about markets. And from that will stem the type of model that you want to apply to looking at portfolio returns and stock returns. We're using the one that Fama and French have developed, which lines up with the way that we tend to think about markets in general. But it is kind of crazy to think about too, that you could just say, well, no, I believe markets work this way. And therefore you would use a completely different factor model, which would completely change your portfolio construction. And there's no way to prove which model is the right one. And that's actually one of the things Fama's written about in his past papers, this idea of the joint hypothesis problem, which basically says that a test of market efficiency using an asset pricing model is jointly a test of market efficiency and a test of the asset pricing model. Now that's tricky because you can prove, as we're going to talk about in a moment, you can prove that the market is inefficient using an asset pricing model. You can show based on the risks in my asset pricing model, the market is not pricing securities properly. Boom, market inefficiency. But someone else can say, well, no, your model's wrong. And nobody can prove what's right. So it's called the joint hypothesis problem. And this is a real issue. So because of that, you can't prove market efficiency with an asset pricing model, no matter how good the model is. But it does start to get pretty interesting when a model like the Fama-French Five-Factor Model explains the vast majority of return differences between two portfolios. Like, it still can't be proof of market efficiency, but it starts to get to a point where it's like there's not a whole lot of return differences that are left unexplained. Anyway, so the original risk factor, and this is I guess a bit of a quick history lesson on asset pricing models. But the very first risk factor was the market, the equity risk premium, market beta, as it's known. And the first time that expected returns were related to risk, to market risk, was through the capital asset pricing model.
Yep. So
this is classic finance sort of 101 capital asset pricing model. Now, a cap weighted index fund, total market index fund, should have a market beta of 1, always. And if we took a portfolio that was 50% market and 50% cash, it should have a beta of 0.5. If two portfolios, and this is my comment a minute ago about explaining differences in returns. If two portfolios have the same market beta, but have differences in returns through a CAPM lens, that difference in returns might be portfolio manager skill, or it might be related to some as yet unidentified factor. Correct. Hadn't been identified yet. And that ties back to the joint hypothesis problem. Now, a portfolio that, we mentioned this earlier with alpha, a portfolio that delivers higher returns. So in those two portfolios that we were comparing a second ago, if one of them has higher returns given its market beta, that's great for the investor. That's an excess risk-adjusted return. So you're getting extra returns without taking on additional risk. Now the CAPM, so that was in the early 60s, I think when CAPM came out. By 1972, Fisher Black had come out with a paper showing some flaws. And then Rolf Bonds in 1981 came out with his paper on the relationship between return and market value of common stock. So this is the first time that someone published data showing that small stocks, from a CAPM perspective, had persistent alpha. These stocks were beating the market without taking on extra risk as measured by the risk of the market as a whole. And then in 1985, there was another paper that documented the same thing for value stocks. And the title of their paper was actually Persuasive Evidence of Market Inefficiency. It was pretty interesting to look at how they wanted to title their paper. But then Fama and French, speaking to the joint hypothesis problem, they came out in 1992 with a paper that said, okay, so we've got small stocks with these persistent alphas. We've got value stocks with these persistent alphas. Maybe we just need to account for the risk of those types of stocks in our asset pricing model. So they came out with their now fairly famous 3-factor model, where they said, we think asset prices reflect the risk of the market, but also the risk of company size, where small stocks are riskier than big stocks, and also the risk of relative price, where cheap stocks are riskier than more expensive stocks. Value stocks are riskier than growth stocks. And when they put those independent risks into a model together, a lot of those anomalies went away, which I guess is obvious. They built a model to make the anomalies go away. But the interesting part from a portfolio evaluation perspective is that the ability of the model went from about 65% or so with the CAPM in terms of ability of explaining differences in returns to about 90% with the 3-factor model. So all of a sudden, the explanatory power of the model becomes extremely strong. One of the really interesting things to think about with a 3-factor model is that there was a sort of loose concept that it was related to risk, but there was no real model to say why that's true at the time. Like, yeah, it kind of makes sense small stocks would be riskier. Yeah, it kind of makes sense value stocks would be riskier, but there was no sort of all-encompassing valuation framework to say how those things related or should relate to each other. So then later research, so 2013, 2004 and 2013, people came out with papers showing anomalies in the 3-factor model. So now we've gone from the small and value being anomalies for CAPM and the 3-factor model solving it. And then investment, so companies that grow their assets aggressively tended to have lower returns than companies that grew them more conservatively. And then companies with more robust profitability tended to outperform companies with weaker profitability. And those alphas in the 3-factor model were persistent. So again, we have this asset pricing problem. And Fama and French, more recently in 2015, I think, came out with a new paper where they introduced their 5-factor asset pricing model. The thing that I love about the 5-factor model, if you can love a model, is that it's rooted in valuation theory. So I mentioned with the 3-factor model, it was more of an empirical model where we had these empirical observations. When you incorporate them into an asset pricing model, it makes a lot of anomalies go away. Cool. But with the 5-factor model, they took the theoretical valuation framework of the dividend discount model.
Yep.
Where a company's value is theoretically the present value of its expected future dividends discounted at whatever discount rate. They took that concept, applied the theory of dividend irrelevance from Miller and Modigliani, and when you transform the dividend discount model to include dividend irrelevance, and we talked about this on a recent episode, but basically if dividends are irrelevant, the dividend discount model turns into profitability minus investment in place of dividends. Otherwise, the equation stays the same. But that ties together all of the elements that go into the 5-factor model. So the cool thing about that is now we have this empirical evidence that these anomalies exist. So you've got low price stocks, you've got more profitable stocks, and you've got stocks that grow their assets aggressively. Those are all independently discovered empirical observations, but then you've got this unifying theory that ties them all together to sort of justify their use together in a model, which I think is pretty cool. And that's one of the tricky things with multi-factor asset pricing models is that nobody tells you, nobody has the answer for which factors you should include in the model. And I guess I alluded to that earlier when we were talking about, how do you pick a model? Well, that's the cool thing about this one is that it starts with the sort of rational valuation framework and then plugs in or spits out, I guess, the factors that would make sense to include based on that. Now, this model has a few predictions, which we've kind of already talked about, but the model predicts, and keeping in mind the empirical data are one thing, but the model predicts the same thing that we observe empirically. The model predicts that cheaper stocks will outperform more expensive stocks. Again, we see that empirically. More profitable stocks will outperform less profitable stocks, and then stocks that invest conservatively will beat stocks that invest aggressively. The next challenge was measuring those things. So we and this came before the 5-factor model. I should have said it first, I guess. But measuring profitability and investment, because it's not current profitability you have to measure, it's future profitability, because we're discounting future profits. Nobody really knew how to measure that, but Novi Marks in 2012, and there's another paper in 2013 that showed how those things could be measured with reasonable reliability to actually be used in an asset pricing model. So all that culminates in the 5-factor asset pricing model that we're now talking about. How do you build a portfolio based on that? We know these 5 systematic risks are important to asset pricing, therefore to expected returns. So what can we do as investors to take advantage of that? Which is the question at hand, I guess. Now, company size is a really interesting one in all of these models. And you may notice that it didn't show up in I guess we didn't show the actual equation, but in the dividend discount model, there's no variable for company size. So it doesn't directly show up in that framework, which is interesting because Fama-French still included it in their 5-factor asset pricing model. And we'll talk more about this as we go through, but small caps on their own, and actually people who listen to the podcast know this already because we've talked about it a bunch of times. Small caps on their own have not had a statistically significant premium, which is pretty fascinating. And even you can even push that further, where Bonds in 1981, the data set that he used to come up with the original size premium, if you go back and run his analysis again now, because the CRISP database that he used is always getting better, they're always improving the data series. And Tyler Shumway, I don't remember what year he wrote the paper, but he did a paper correcting for the delisting bias in the CRISP database. Wow. And I can't remember the exact details, but basically it made small caps look worse. And so if you go and rerun the Bonds research with the Shumway corrections, which are now included in the CRISP data, you no longer get a statistically significant premium. So it's kind of like it's never really existed on its own. But that on its own is important. So as we've talked about in the podcast a few times, all of the other factors are significantly stronger, both economically and statistically, in small caps. There's a paper that we talked about in a recent episode by Blitz and Hanauer. I think it was Journal of Portfolio Management the paper was in. And they showed this by comparing, by running regressions on the academic factor portfolios, which consist of 50% small caps and 50% large caps. Running regressions on those portfolios with a market capitalization weighted factor portfolio. And they found statistically significant alphas, which is another way of showing that the risk factors are much stronger in small caps. And this is a theme that comes up a few times in these discussions. Fama-French, they had addressed it in their paper too. They mentioned that even though size doesn't show up in the valuation framework, empirically it's so strong that it has to be included in the model. Now the other big one is momentum that doesn't show up in the theoretical valuation framework. So again, we know empirically that stocks that have been doing well tend to continue doing well for a bit. That was from Jagadish and Titman in 1993. And that has continued to be true empirically. But what do you do with that is an important question. If you buy, like in our old model portfolios, we had IUSV and IJS, which are just value funds targeting value. Now, what's the problem with targeting value from the perspective of momentum? The problem is when a stock crosses the threshold and goes from being not a value stock to being a value stock, it's going to have negative price momentum. And momentum is a well-documented empirical factor. So that means you're betting against momentum by buying stocks when they become value stocks. So that's a problem from an expected returns perspective, or maybe not from an expected returns perspective. I don't know what you'd call that. It's the problem from an empirical finance perspective, I guess. You don't want to be short momentum. So the products that we're talking about in our new model portfolios, they actually account for that by delaying trades based on momentum, or delaying or accelerating, I guess, which I think is important. So it's almost a six factor model, I guess, if we're including that in a way. Okay, so why do we care about all this in the first place? The premiums have been pretty big, which makes them kind of hard to ignore. And there's lots of extra thinking and hassle that goes into this, so it's important to know that what the premiums are. So we're gonna go through that. Now, when we're talking about factor premiums, I think one of the other and little known facts that's important to consider is that the academic long short portfolios, and we mentioned this briefly with the Blitz and Hanauer research, the academic factor portfolios are based on 50% small cap, 50% weight to small caps, and 50% weight to large caps. So the value premium, as an example, is the cheapest small caps plus the cheapest large caps minus the most expensive small caps plus the most expensive large caps. Now that's the best way to construct the factor portfolios for the purpose of asset pricing. So to use them in a regression model to see what's driving differences in returns in portfolios, that's the best way to construct the factors. But from a, looking at how stuff is done and saying, is it worthwhile to pursue this? That's a little bit less relevant, just because you're looking at a portfolio that's significantly overweight small cap stocks, which not all portfolios are. For example, the model portfolio we're talking about here today has about 30% in small caps. The academic factor portfolios have about 50% in small caps, and the market has about 10%. So you're talking about the value premium, like market-wide value premium, that's 10% in small caps. The academic value premium is 50% in small caps. And we've talked about how factor returns are stronger in small caps, so that overweighting arguably makes the factor premiums look better than they would actually be in a portfolio that's not heavily overweight small caps. Sticking with me here?
I'm with you. Keep going. I don't want to break up your train of thought.
Okay. So for the US premiums, I document in the paper the value weighted and the academic premiums, because Ken French has data on both. And then for international and emerging markets, I just did the academic factor returns because I didn't have the capitalization weighted. But if we just go through quickly, so for the value weighted portfolio, for size, we have 1.58% premium. So small stocks beat large stocks. This is the 30% of the cheapest stocks minus the 30%, minus the 30% biggest stocks from 1963 to June 2020. The small portfolio beat the large portfolio by 1.58% per year on average, which is a lot.
Just to be clear, that's the value weighted portfolio, not the value weighted.
Correct. Value weighted.
Value weighted.
Yes. Then for value, so for the cheap stocks minus the expensive stocks, in the value weighted portfolio, it beat value beat growth by 1.99%. And then for profitability, it was a 2.59% premium. And for investment, 1.92. Now, in terms of statistical significance, the small cap premium was not statistically significant over that time period. And interestingly, neither was the value premium from a value weighted portfolio perspective. Now, if we go to the academic premiums, again for the US, so small minus big, but the value weighted was 1.58% premium. If we go to the academic factor, so weighted 50% small, 50% large, that premium increases to 2.04%.
Interesting.
And then for value, it went from 1.99 to 2.68. Profitability, it increases from 2.59 to 2.8. And for investment, the premium increases from 1.92 to 2.93 by switching to the academic factors. Now, I mentioned that our model portfolio has about 30% in small caps. So it's not like one of these is right and one of them is wrong. I think in our case, with the 30% weight in small caps, it's going to be somewhere in between. Like, what is the premium you expect?
Right.
Yeah. So then if we look at the developed ex-US, I'm just going to rip through these a little more quickly. So small stocks beat big stocks by 0.81%. Value beat growth by 3.01%. High profitability beat low profitability by 4.30%. And conservative investment beat aggressive investment by 1.34%. And for emerging markets, it's similar. I don't think we need to keep going through it. But the main takeaway here, the main point, is that in all of these major markets that we're talking about, I mean, it's basically the whole global market, the factor premiums have been economically large. For the most part, they've been statistically significant. So, I mean, I guess why would you ignore them in portfolio construction? I don't know.
That's exactly what Marlene Lee told us when she was on last January, is why would you ignore information that's out there to be had?
Yeah. So I took a couple of examples just to like, how do we actually apply this to portfolios? And it's important to point out too that these regression models and the factor premiums, Dimensional, for example, is not actually using 5-factor regression models to build portfolios. They obviously know about that, but it's not one of the things they're actually using practically to build portfolios. And we didn't either. We didn't rely explicitly on that. It was one of the few criteria that we looked at when we were building this model portfolio. And it's also worth noting that the intention behind this model portfolio is to look somewhat similar to the portfolios that we use for our clients. We use dimensional mutual funds, which aren't available to the public, except for through firms like ours. So this model portfolio is designed to look somewhat similar to that in terms of regression coefficients, but also in terms of characteristics, which you can argue are more important than regression analysis. So one of the things that I want to look at is let's take an index that we know has factor loading. So I took the dimensional US Core Equity Index and compared its returns to just a US total market index. So from 1975 to June 2020, the dimensional US Core Index returned 13.52% with a standard deviation of 15.43, whereas the US market delivered 12.12 with a standard deviation of 15.41. So we see right there from a standard deviation perspective, we're getting higher returns without any extra risk. Pretty cool. Now, if you're an active manager before multi-factor asset pricing models exist, you can show this and say, look, I'm generating alpha. But as we would expect with 5-factor regression, we can see that all of that excess return is being explained by excess exposure compared to the market to small stocks, value stocks, highly profitable stocks, and to a lesser extent, in this case, stocks that invest conservatively.
That's the key takeaway. There's always a reason.
Right. So we've just taken this hypothetical active manager that could charge 2 and 20 or whatever, and we've now said, well, actually, you can do that systematically with an index, which is the same kind of thing that the AQR paper that showed that Buffett's alpha can be explained by systematic factors. They took a similar approach and said, well, here's a set of systematic factors that we know drive stock returns. If you account for those in Warren Buffett's historical success, his alpha actually becomes statistically insignificant. So it's the exact same kind of thing, which I think is pretty fascinating. Now, I also looked at dividend growth investing because that's another case where people often believe that there's a superiority, but the question that we can look at with the asset pricing model is, are dividends special in the sense that they're generating alpha, or do dividend stocks just have extra exposure to the common risks that we're talking about? So for this one, I looked at VIG, the Vanguard Dividend Appreciation ETF from June 2006 to June 2020, and it had almost the identical return to the market. And actually, I looked at this in April. People know I've been working on this paper for a while. And between April and June, the VIG went from beating the U.S. market over the full time period to trailing it by 3 basis points annualized.
Oh, no way.
Just because dividend stocks got smoked in the downturn and have recovered more slowly. But even still, VIG had very similar returns, off by 3 basis points, with substantially lower standard deviation. So again, we have this question of, are dividend stocks superior? Well, if we plug it into the asset pricing model, the Fama-French Five-Factor Model, the model explains 94.8% of the monthly variation in returns. So basically all of it. And the fund does have excess exposure to more profitable companies and companies that invest conservatively. And I mentioned earlier the relationship between the dividend growth, the dividend discount model and the five-factor model, and just how they're related theoretically. And we kind of see that here, where if a stock, if a group of stocks have high dividends that are growing, we would probably expect them to be highly profitable, and we would probably expect them to be investing conservatively.
Yep.
And this is exactly what we see with this analysis. So another way of saying all of that is that the excess risk-adjusted returns of dividend growth stocks over this time period are pretty well fully explained by their five-factor risk exposures.
Do you think the standard deviation is a lot lower than expected? Like being the 12.5 versus the 14.7? Is there anything in that information?
It should all be captured by all the variation in returns is being captured by the
factors,
by the model here. So I don't think so. I mean, the annualized alpha on this fund is statistically insignificant. So I guess we can just say it's zero. It economically, it was negative 0.48% annualized, but the T-stat's only 0.55. So it's really, statistically, it's zero. So yeah, I don't think so. I think it's the model's doing quite a good job of explaining the returns here, which for a dividend investor is problematic. This is a bit of a digression, but if you're a dividend investor enjoying the better risk-adjusted returns of dividend stocks, if you're really just getting a repackaging of systematic risk factors that exist in stocks that don't pay dividends or that don't grow their dividends or whatever, stocks that don't meet the criteria of a dividend investor, you could be missing out on diversification, which can be detrimental. But the bigger one, I think, is if we look at these companies specifically in VIG, this ETF also has negative exposure to the size premium. So it's larger than the market, and it has negative exposure to the value premium. Now, because this thing's targeting dividends, those risk exposures could change over time if the characteristics of dividend stocks as a whole change over time. But at this point in time, or at least from 2006 until now, you had on average negative exposure to value and to size. So if someone looks at that and says, well, I like dividend stocks, you can also look at it and say, well, you're just getting a suboptimal mix of, or a potentially suboptimal mix of factors. You could address that by targeting the factors directly instead of...
Bingo.
Right. Okay, so all that's fine. We've talked about the full period premiums, which is important. I think the persistence is also important. We've looked at these long periods where factors have been positive over the full time period, but if you're living through being a factor investor, as we're doing now with the value tilt, you may have periods where the factor underperforms. So one of the other things I wanted to look at in the paper is how often does that happen? I'll go through this fairly quickly, but over 10-year periods, some of these data are fascinating. Over 10-year periods, the U.S. market premium, so that's the U.S. market minus 1 month U.S. Treasury bills, has been positive 80% of the time.
Since 63.
Since 1963.
So 57 years.
And then small stocks have beaten big stocks 71.5% of the time.
These are rolling 10 years, right?
Rolling 10-year periods, yeah. So overlapping 10-year periods with a 1 month step. Value stocks have beaten growth stocks 86% of the time, which is kind of staggering. So that's in more of the 10-year periods, value stocks beat growth stocks than the market beat T-bills.
And everyone, it's a given to invest in the market for most people.
Right.
So you're basically saying if you believe in the market, you should believe in these other factors also.
From this perspective of rolling 10-year periods,
yes,
they've been more reliable than the market.
Exactly.
Statistically, it's a bit more debatable. Like statistically, the market premium has been more reliable than value, for example. Actually, it's been statistically more reliable than any of the other premiums, but over rolling 10-year periods, it's a little bit different. So it's more like if you're thinking about could you stick with a factor or would you stick with a factor, I think that's where these data are really interesting. For the profitability premium, 85.6% of the time, and for the investment premium, 98% of the time, which is kind of staggering. Over 20 years, all premiums in this data from 1963 to 2020, all premiums except for small cap were positive 100% of the time over 20-year periods. It's not that many non-overlapping periods, so I don't know how much insight you can draw from that data, but still kind of interesting. For developed international, excluding US 10-year premiums, I don't have 20-year just because it would only be one non-overlapping sample. 10-year premiums, market 87.55% of the time beat T-bills. Small caps 86% of the time, value 90.87, profitability 100% of the time, and conservative minus aggressive investment 92% of the time. I'm going to skip over emerging markets. Sorry, emerging markets. You can read it in the paper though if you're listening. It's similar across the board.
Yeah.
Now the other thing that came out of doing this paper that was really interesting was looking at how the factors behave relative to each other over time. Somebody did a post in the Rational Miner community about this recently, where they posted some really interesting charts that they generated with some code, and those were kind of neat to look at. I had a chart. I actually still have a chart in the paper just showing the 10-year rolling premiums all together on a single chart, and you can see how they behave differently. But the other thing that Raymond, our director of research, suggested that I add when he was reviewing the paper was the correlation matrices for all the different factors. And I'm not going to try and explain them because it's just a bunch of numbers, but it's in the paper, and it's actually unbelievable. It's, low for the most part, or negative, actually most of the time negative correlation across the factors. Like if we just pick one as an example, take the market. That's an easy one. So the market correlation coefficient is for U.S. stocks between 1963 and June 2020. The market has had a correlation of 0.29 with small caps, or with the S&B premium, negative 0.22 with the value premium, negative 0.21 with the profitability premium, and negative 0.38 with the investment premium.
In plain English, that means?
It means the premiums perform or show up at different times than market returns as a whole. So again, we're talking about why would you want to do this? Additional expected returns are a major reason, but this low to negative correlation of the other alternative, I guess, whatever you want to call them, the other risk premiums with the market risk premium, from a diversification perspective, I think becomes pretty compelling and hard to ignore. And we're going to talk about a couple sort of anecdotal examples of that in a second. And then I have that data in here for developed and emerging markets as well. Similar again, but you can take a look at that in the paper.
So is it reasonable to expect a smoother ride to a higher return?
Which is exactly what Dimensional always says. They say that this increases the reliability of your outcome. And we're going to speak to a couple of examples. So we talked about the rolling 10-year periods, and we talked about the correlation. So we've kind of already covered this conceptually, but it's really just interesting to show a couple of these extreme examples, I guess. So there's the lost decade in the US, which a lot of people know about. So for the 10 years from the 10 years ending July 2009. Now over that full period, the US market index, the CRSP 110 index, lost an annualized 0.19%. Pretty bad. Trailed T-bills, which returned 2.95% over the period. So your risk premium was brutal. But over that same time period, U.S. small value stocks measured by the Fama-French U.S. Value Index returned 9.51%. Pretty significant difference there.
Yep. And
the Fama-French U.S. Value Research Index returned 3.78%. Not as exciting, but still a lot better than losing 0.19%. And then the U.S. High Profitability Research Index returned 2.09%. So you can see right there where that's a period where the market did quite poorly over a 10-year period, over a fairly long period of time. And small cap, being the biggest outperformer there, delivered a substantial premium. Now, I also looked at this in aggregate, and I guess this shows up in the correlation data too, but this is another way to look at it. So I looked at the 111 10-year periods ending between July 1973 and June 2020, where the market premium was negative. So 111 10-year periods where the U.S. market had a negative premium.
Yep.
over those same periods, small minus big, high minus low, value, and profitability, investment, conservative minus aggressive, were all positive.
Which is all of those?
All 111 instances of the market premium being negative. SMB, HML, and CMA were all positive.
Wow.
RMW was negative in 53 of the 100, profitability was negative in 53 of the 111 periods. Pretty crazy, right?
Yeah.
So again, we see that diversification angle for why an investor may want to do this. So here's another one. The single worst time to retire in U.S. stock market history, the available history, was December 1968. From then until January 1984, the U.S. market actually gained 7.26% per year, but trailed T-bills and barely kept pace with inflation. So you had about a 4 basis point annualized return from December 1968 until January 1984 in real terms. So when you run like the 4% rule analysis, that's always the time period where it breaks. Now, over that same time period, small value returned 15.8% annualized. And this isn't SMB. That's not small minus big. That is the Fama-French US Small Value Index.
Right.
The long-only index, not small minus big. And the value index returned 13.46%. So again, we see an instance, and I'm totally cherry-picking data, but it lines up with the broader sample, so I don't feel bad about it. And then the last one that I'll talk about is Japan. So July 1990 to December 2019, which is a staggeringly long time for a negative or a non-existent risk premium.
This one before. It's a great one.
It's crazy. So the Fama-French Japan Market Index returned 2.36% annualized over that full period, which trailed U.S. Treasury bills, 1 month U.S. Treasury bills, which returned 2.63%.
It's for 29 years.
It's crazy to think about. It really is. Now, over that same time period, the Japan High Profitability Index was actually not a whole lot better, 2.27%. Actually a little worse than the market. But the Dimensional Japan Small Cap Value Index and the Fama-French Japan Value Index delivered annualized returns of 5.43% and 7.96% respectively. So again, we see another instance of these indexes representing exposure to the non-market factors, delivering meaningful outperformance at times when the market didn't do so well.
So the benefit of factor diversification.
100%. It just speaks to the reliability piece where, yes, you can have long times where stocks don't pay off, where the stock market doesn't pay off, but there can still be other risk premiums over those periods of time that do pay off. So what do we do with all this information?
I can hear the listeners asking that now.
We use Dimensional's products, as we've mentioned, and they're, as far as we can tell from the ongoing pretty extensive due diligence that we do, they're doing a great job, I guess is the easiest way to say it. The challenge practically for people who are not our clients is that their products aren't available. You can't just go and buy them. Although that's changing a bit. They've released some ETFs, not quite a full suite of products. Like you couldn't recreate our client portfolios with Dimensional's ETFs yet. It seems sensible they would get there soon, but I have no idea if they will. Last time we made a model portfolio, we used the 3-factor model as the basis for the portfolio. So we basically just ignored, not completely, we somewhat ignored profitability and investment in the construction. We didn't use products that targeted those factors directly, is probably the best way to say it. IJS, for example, they do have a financial viability screen, which interestingly results in a profitability exposure. But we didn't pick products that explicitly targeted all 5 factors because at the time they didn't exist, at least not in a format that we thought was sensible from the perspective of costs and diversification. But now, Avantis, so Dimensional's launched ETFs. Avantis is another company from some people that actually left Dimensional, which has also launched ETFs. And Avantis has, the very, very similar approach to Dimensional. Like you'd be splitting hairs to explain the differences in execution, although they may not agree. I'm sure they'd both argue that the differences are larger. Maybe they wouldn't. I don't know. But for the purposes, for practical purposes, they're very, very close in terms of the risk, the risks that they're delivering in their products. Now, the nice thing about what Avantis has launched is that they have a couple of small value ETFs. Dimensional has only launched core ETFs, which are like a lightly tilted total market exposure. With Avantis, they have a couple of products that give you pretty targeted, pretty extreme exposure to the smallest and cheapest companies that exist in the market. So that's valuable to us because a couple of things that we're worried about in this portfolio construction process are withholding taxes, which can be problematic for Canadian investors when you're using US listed ETFs. Costs, currency conversion costs, US estate tax, all these additional complications that start to be introduced when you're using US listed ETFs. So because they have these more extreme small cap value tilted portfolios, we felt like it gave us an opportunity to use a mix of, I guess, similar to what we did last time, a mix of Canadian listed ETFs where you don't have to worry about currency conversion or the extra layer of withholding tax. But you can still, with a relatively small percentage of the portfolio, you can still target a meaningful amount of factor exposure. Now, given the choice, we would prefer, and I want to be clear about this, we would prefer to have a more diversified factor portfolio. Like Dimensional, with Dimensional's portfolios, you're tilting toward the factors across the full spectrum of market capitalizations. So you've got your large value, your mid-cap value, your small value, whereas with this model that we're introducing here, you're getting all of your factor exposure in small caps. It's an interesting trade-off because we know the premiums are stronger in small caps, which kind of allows us to do this. But at the same time, it reduces the diversification that you're using to capture the premiums. But overall, we thought, as people know, we've been working on this for a while. We thought a lot about the different trade-offs involved, and this is what we decided makes the most sense, at least for now. So the ETFs that we're using for the factor exposure are the Avantis US Small Cap Value ETF and the Avantis International Small Cap Value ETF. So we're getting small cap value exposure in US and international markets. Excluding emerging markets, there aren't a lot of great ETFs that really target small and value. Avantis does have a product, but it's kind of like the Dimensional products, more of a lightly tilted total market ETF. And in the paper, there's a bunch of analysis with regression and historical characteristics and stuff like that of return characteristics of those ETFs. I won't dive into it now. You can read the paper if you want to see more about that. So the actual model, it ended up being 6 ETFs for the equity portion. So if you want fixed income, it'll be another ETF or 2, depending on how you do that. But not too complicated. I mean, the same as the previous one, 6 ETFs. So here it is. Everybody ready? So we did 30% in XIC. So you've still got a home bias, which we think makes sense. And we've talked about that pretty extensively on the podcast in the past. 30% VUN. Now, this is an important change, actually. In our previous model portfolio, we had XUU. One of the things that's come up with PWL's research team recently is that the way that BlackRock has decided, or our iShares has decided to execute on XUU, is by using 3 underlying ETFs. So it owns 3 US listed ETFs of small cap, mid cap, and large cap stocks. Now that sounds fine, right? If you can pull it off, efficiently. But it's actually had pretty significant tracking error relative to its benchmark. So this is something that was flagged this year by our research team, and basically it just hasn't been super impressive execution by iShares, which shows up. Like you can go and look at I didn't pull it up to talk about right now, but you can just go to the iShares website, and the pretty meaningful tracking error shows up. I'm just gonna look it up here. So the 1 year tracking error ending November 2020, XUU returned 14.12%. Its benchmark returned 15.42%. Like it's pretty serious. Pretty serious. So anyway, in speaking with our research team, the suggestion was, even though VUN has a higher MER, XEU's at 7 basis points, VUN is at 16. Their suggestion was just based on the continued concerns about execution of market exposure based on the way they've decided to construct that fund and what's been happening recently, that it makes more sense to go with VUN. So I thought that was pretty sensible. So that's a notable change from last year. So 30% XIC, 30% VUN, 10% AVUV, that's US small cap value, 16% XEF, that's just international core, 6% AVDV, so that's in total 16% of the portfolio is in small cap value, and 8% in XEC for emerging markets. One of the things I like about this setup is that with VUN, you can flip out VTI for VTI and an RSP to eliminate withholding tax if you want to go that route. And likewise for XEF, you can switch to IEMG. In taxable accounts with XEF, because it's Canadian listed and holds securities directly, you're not going to get hit with the extra layer of withholding tax that you would get from using a US listed ETF.
Yep.
And that was one of the reasons we decided to go with this overall structure. Fees end up being very close to a cap weighted benchmark. So you get about 14 basis points of total management fees for the factor tilts versus 11.
Incredible.
For the market cap.
Incredible.
Pretty cool. And then if we look at the historical return characteristics for the tilted model versus the benchmark, which is basically just the same portfolio with the small cap and value stripped out, that's the benchmark, but still using ETFs. Over 20 years, the factor tilts delivered us 5.78%, and the benchmark delivered 4.96%. It's the difference between turning $10,000 into $30,800 over 20 years versus $26,300 over the same period. Lowest 1 year return is basically the same. Standard deviation was a little bit higher for the factor tilted model, but we got some extra returns in exchange for it. So that's basically it. We'll hopefully be able to post the PDF that shows the model portfolios like we've had in the past by the time this episode is released. But that's it.
The paper as well, do you think will be posted, or is that going to come out
Probably
afterwards?
not by Thursday. It's with our marketing team now to get cleaned up and make all the charts look nice and all that kind of stuff. So they did say by the end of this year it'll be realistic to have the full paper available. But I think the model portfolios PDF, I just need to plug in the updated numbers with the new holdings, I guess. But we already have that document created.
Well, I can hear the collective cheers of many listeners because this has been a very common request on all the different chat boards.
Yeah, and I hope it's useful, and I hope it doesn't throw, like, honestly, the factor exposure is a big change from last time. Like, people that were holding IJS and IUSV, now we're looking at switching that up to be more concentrated in small cap value, but also giving international small cap value exposure. That's a pretty meaningful change. The US equity, like, that's a bigger holding, 30% of the portfolio, and changing from XEU to VUN, that's another big one that, if there was an embedded tax liability to make that change, would I do it? I don't know. That's a tough call. And VUN's got a bit of a higher fee than XEU as well. So it's not necessarily obvious. Given the choice to pick one now, we don't know if iShares is going to clean up the implementation of XEU. So VUN may be a better call for now. But overall, I mean, like I said before, I think it's a relatively straightforward portfolio to implement.
Yeah.
We didn't make it too crazy. It's obviously a lot harder than just buying XEQT or something like that. But if you're willing to put in the time for the extra, whatever you expect, 50 basis points or something, who knows, then yeah.
Great. Nice work. So as you mentioned, we're skipping the planning topic this week. We'll have another topic for planning in the new year. And we'll go quickly to the bad advice of the week, just a short one this week. Joel passed this article along to us, and we sent off a nice zip-up hoodie, Rational Minder hoodie to Joel's. That offer's still out there. If you happen to come across a good idea for bad advice of the week, just send it through to Ben or I, however you like, Twitter, email, whatever works for you. Anyways, this is an article that came from the website Seeking Alpha that was published on November 9th, 2020, called the Vanguard Total International Stock ETF. Right idea, wrong implementation. Oops. Okay, so the article goes on to say investors have multiple reasons to seek exposure outside of U.S. equities. An out-of-control pandemic, high unemployment, high debt, and slow economic growth. Okay, so far so good. Meantime, other regions, specifically China and Asia Pacific, have superior near-term potential, in my opinion. Here come the opinions. So it goes on to say, while a total international stock ETF sounds like a good idea, the total part of the description means too much diversification that drags down performance. Like, what are you talking about? So as a result, the author offers investors two superior alternatives that focus more on specifically on China and the Asia Pacific region. So I do not subscribe to Seeking Alpha to get the whole article, but the notion of choosing regions, especially after listening to your whole talk about factors, does not make a lot of empirical or theoretical sense to me, and certainly not based on near-term potential. I mean, it's absurd, right? I mean, that's not the point of this kind of ETF, right? You'd be far better off to understand all the stuff that you just went through for 40 odd minutes or so about what factors to use to get higher expected returns from a theoretical and empirical standpoint than try to pick what region. And then to go and slam an international stock ETF to me is nuts.
Yeah, it is nuts. There was a little discussion in the Russian-minded community recently about this idea of reducing exposure to the U.S. Yeah, I don't know. I mean, it's kind of tricky because, and bond ETFs have the same problem. But if you're a market cap weighted equity ETF investor, and this is something that I've honestly been a little bit concerned about. We haven't talked about it on the podcast much, but if you're total market, you're getting always exposure to the most expensive. More exposure to the most expensive stuff in the market, and increasingly so as it gets more expensive. So I don't know, like having that constant overweight to small cap and value just seems to be a whole lot more sensible to me, and rebalancing out of large growth into small cap value as it increases, as opposed to rebalancing, into it. Seems sensible, but
keep buying cheaper assets. That's what you're doing.
But there's also international diversification too, right? Like one of the things that I didn't talk about when I went through those examples of extended periods of market underperformance is an internationally diversified investor in the US last decade actually did fine. An internationally diversified investor from the Japan 29-year period of underperformance, likewise, they did fine. So, international diversification is worth something too. So I think that's important for people to take away is that, well, I guess this article you're talking about was about a total world fund, but if you're globally diversified in market beta, I mean, that's pretty good still as a starting point. We're talking about improving the expected outcome a bit, but I don't want to scare people into thinking everybody needs factors or you're going to, suffer terrible stock returns. I don't think that's true. I think there's room for improvement, which is what we're trying to do with this model. But
no need to predict which areas of the world are going to be near-term winners.
Yeah, to speak to your bad advice article, for sure not. And we did an episode a while ago on the difference between economic success and stock market success. And in that episode, we talked about how economically successful or expected to be successful countries often actually have worse stock returns. Yep. It's just like value investing. Like the least GDP growth leads to the highest stock market returns, which is super counterintuitive, but it's an empirical reality.
Anyways, Joel, thanks for sending the article along. Love getting articles from people. Anything else to add?
No, I think that's good.
Great. Thanks for listening.